A very good morning to everybody. Welcome to the first webinar, quarterly webinar of 2020 from a very wet Cape Town. I hope you all, especially those in Cape Town, are quite snug, and those around the country, hope you're doing well this morning. We have a jam-packed lineup this morning. We'll introduce our speakers, one of our own, two of our own this morning, with some really interesting content. I'm going to pass the mic over to Eva Medrova.
Thank you very much, Dwayne. As per Dwayne's introduction, my name is Eva Medrova, and I look after the investment consulting at Sygnia Asset Management. What I will cover this morning is just a quick market and economic update. So I'll summarize last year as well as the outlook for this year. And very importantly, I'll cover performance and the strategic assets allocation update.
Eva, we're looking forward to it, especially after the dismal 2020 and the great start to 2023. The next speaker is Leanne van Wyk. Leanne, over to you.
Good morning, everybody, and to Surf and Sygnia. Thank you for having me to speak again. And today I'm going to talk about contributions to retirement funds and all the new laws around that.
Colleen, would you like to just do a quick introduction?
Hi, I'm Colleen Viljoen. I am the Head of Administration for the Employee Benefits area. I'm just here to answer any practical questions that might come out of Leanne's session.
Great, Colleen. We're very eager to know how SURF is going to be complying with the new conduct standard. And last but not least is Olufile Moya from Fairheads. Olufile, over to you.
Olufile Moya. I'm creating a future for your kids under Phase Benefit Services. I'm the Director of Consulting, Marketing and Communication. I'll be covering what is this vehicle called beneficiary funds that allows me to confidently say I'm creating a future for you and what value are we getting out of it.
Well, we're very excited to hear your presentation. So let's kick it off, and we're off with Eva Medrova. Eva, take it away. Thank you.
Thank you very much. So as I mentioned, this is the agenda for this morning. So I'll get straight into it, starting off with the market and economic update. First, having a look at what happened in 2022. As Dwayne alluded, it was actually a horrible year for markets. There was a lot going on with the war between Russia and Ukraine, which caused an energy crisis all over the globe. Inflation was already high, and now with these high energy prices, it created a bit of a cost of living crisis situation, with inflation really reaching, 40-year highs in developed nations such as the US and the UK. Now, with very high inflation, central banks respond by rising interest rates, which is not good for stock markets as well as for individuals. And on the back of all of these, circumstances, we saw that markets were pretty much in the red for most of 2022. So looking at this summary of the broad asset classes, you can see that pretty much all equities other than South African equities gave us negative returns for the year. South African equities only at 3.7, so a positive return, but much lower than inflation. If you look at the green bars, you see that the themes that we like to follow at Sygnia Asset Management, these are high growth themes, but in very volatile market environments, they tend to not do so well, especially in a rising interest rate environment. And we can see that all themes other than healthcare, which is seen as quite defensive, gave us negative return. And then in yellow, you have these sort of safe haven income type of asset classes, but not even those asset classes all gave us positive returns in 2022. We can see property was down, global bonds were down, and then some of the others gave us positive return. Now, the typical 60-40 fund, now a blend of 60% equity and 40% bonds, is quite popular as a portfolio, and the average US balance fund was down minus 17% for the year, as you can see, due to the fact that global bonds as well as global equities were down. So on the back of this very volatile year, we did see muted returns, but the portfolios luckily are very well diversified across asset classes, and I'll touch on the returns a little bit later on. So that was 2022. We are now in 2023. What do we expect going forward? Well, unfortunately, The outlook for this year is not too rosy, with a recession that's looming in the US. What we're looking at on the slides at the moment is the Conference Board leading economic indicator. And this indicator has predicted every single recession since the 70s, and it's now pointing to a definite recession. The only big question mark is, when will this recession happen? And it's difficult for, the timing to be predicted exactly. It could happen as early as next month, but we believe that it's more likely that we see the US recession in Q3 or Q4. It is likely that this recession is mild, though, due to the excess savings that Americans have. So if you look at the chart on the right-hand side, it shows you this excess savings that Americans are sitting with, and due to the saving is likely to result in spending. So although the economy will be in a recession, the spending will contribute to GDP, and the recession overall is likely to be mild. We have seen the inflation numbers come out of the US recently, and it seems that inflation is quite sticky. It seems to be sticking around, and for that reason, interest rates in America are likely to stay higher for longer. Not too different in the Eurozone. They target an inflation rate of 2%, and the inflation in the Eurozone is likely to remain above these levels right up until 2025. But the good news there is that last year, these are nations that were very dependent on Russia for the supply of natural gas. And, it's actually been incredibly impressive how they have managed to reduce their reliance on Russia and have made, alternative arrangements in order to provide, natural gas and, just general energy. So the inflation was really high, and now that has come down quite fast. In terms of a recession, again, they're sitting on excess savings, which is what you can see on the right-hand side, and the outlook is looking way more favorable for 2023 due to the fact that all of these nations have made alternative arrangements when it comes to gas usage, which is really, really encouraging. They were also helped by the good weather that they had. So, their winter wasn't as cold. We saw record temperatures for, winter days in a lot of European cities, which was positive, as they didn't use as much energy to, warm up. And then China. So China was very topical in 2022. So China was, a very volatile region. We continue to expect volatility out of China, but the outlook is looking way more favorable. And the reason for this favorable outlook is that for the past 3 years, they were one of the last nations to abolish their COVID-19 policy. So the Chinese consumer has pretty much been in lockdown for the last 2 years. And finally, we saw them abolish the zero COVID policy, which the markets received very, very favorably. And now again, just like some of the other nations, because they have been basically locked down, the Chinese consumer hasn't really been going out, spending, traveling. They're sitting on quite a bit of excess savings, and this will result into spending, which will be very positive for GDP. As I mentioned, whenever you invest in China and, emerging markets in general, you do expect it to come with volatility. But over the long term, it still really makes sense as an investment. You cannot ignore the Chinese consumer and this growing middle class population that they do have. So we do have a nice allocation to the China equity market, as well as the broader emerging markets regions in your portfolios, which is adding really nicely to returns since the bounce back in performance. And then South Africa. We do invest the bulk of the portfolios in South Africa across the equity and the bond markets. But unfortunately, the outlook for South Africa is not looking so favorable. We do expect the grey listing to materialize. A decision will be made at the end of this month. The impact will really be more an impact for individuals and companies wanting to transact offshore. So if you wanted to, for example, open an offshore bank account or some type of investment account, you're very likely to have a much bigger stack of papers to complete, increased due diligence, a lot more questions around where the money came from. So this increased due diligence and surveillance for South African individuals and companies. But the bigger problem in South Africa really is the ongoing load shedding. And unfortunately, there's no quick fix to the situation. The load shedding is affecting our GDP growth, so profitability, productivity, and overall consumer sentiment is what is being affected. The excuses from Eskom are around the old infrastructure. However, it's not just the infrastructure, but rather a lack of maintenance and a lack of skills. And this is what you can see in this chart on the right-hand side. So what this chart on the right-hand side compares are similar aged power stations in the US. So that's your red and your blue line. And you can see the energy availability factor over the last decade or so has sort of remained constant and even slightly increased. So they're able to supply as much energy now as they were able to about 10 years ago. Whereas looking at the green and the yellow line, you can see this energy availability factor of the South African power plants just keep coming down. So what this is showing us is, as I mentioned, it's not just down to old infrastructure, but really the lack of maintenance of this infrastructure, the lack of skills, and of course, the unfortunate corruption that we keep seeing in the space. So for these reasons, unfortunately, the GDP growth forecast for South Africa are not looking too favorable. And in our portfolio, we are underweight South African equities in favor of global equities. In the bond space, though, we are overweight South African bonds, as South African bonds are still providing some of the highest real yields in the world. So before I get into the performance of the portfolios, now that I have covered markets and economics really quickly, I just want to show you what the SURF's investment strategy is. So a quick reminder of the investment strategy, as these are the portfolios that I will be focusing on when I touch on the performance. So the life stage model is the default set by the trustees. Each employer select one of 3 investment philosophies, and then individual members can opt out of the life stage model that's chosen by the management committee into one of the member investment choice portfolios. Now, these 3 life stage models follow a glide path whereby they de-risk members from the 70 portfolios into the 40 portfolios, and this happens 6 years before retirement. So essentially, members are going from riskier portfolios to safer type of portfolios, or from more aggressive to more conservative portfolios as they get closer to retirement. So essentially, they have a higher allocation to equities, and as they get closer to retirement, that allocation to equities is slowly decreasing into a portfolio that has a higher allocation to bonds and cash. And one of the 3 philosophies that management committees can choose, the first one is the skeleton range, which is a passive option. Then you have the signature range, which is a blend of active and passive. And then you have the synergy range, which is predominantly active. So it's active on the local side and passive on the offshore side. So the performance update will focus on these 3 life stage ranges. But looking at what markets gave us as at the end of December, if you look down the 1-year column, you'll see that the returns are quite muted. Now, if you think back of that slide I showed you with the broad asset class returns, you remember that most broad asset classes were in the red. So we can see South African equities are up slightly. But if you look further down, you'll see that global assets really gave us negative returns over the year. But despite this, because of the very well diversified nature of the portfolios, if we look at the performance, they gave us small positive returns thanks to the allocation to South African assets over the year. So we can see the signature, skeleton, and synergy ranges beating the benchmark over the 1 year and providing positive returns, returns looking much healthier over the longer term. But January was a really, really good month in the markets. We saw markets really bounce back. So if you look down the column of January, you see some really nice, good, healthy returns. These are now filtering into the 1 year numbers, and we can see that South African equity returns are much higher. Global markets have given us much higher returns. In fact, if you look at emerging markets, just emerging markets alone over the last quarter have given us 15.8%. So the allocation to emerging markets, as well as the equity allocation in your portfolios, has resulted in really, much higher returns as at the end of January. So if you look at the returns of the signature 70, skeleton 70, and synergy 70 portfolios, you can see all beating the strategic benchmark over the 1 year and providing much higher returns. The same goes for the more conservative portfolios that you can look at further down the slide. And again, over the 3 years, we see nice double-digit returns from the portfolios, and over 5 years, still very good inflation-beating returns. So the portfolios, despite the really volatile year that we saw in 2022, the very well diversified nature of these portfolios has helped in terms of the returns. So yes, we have seen a lot of blips of volatility, but over the long term, the portfolios are doing very, very nicely. And that then brings me to positioning. So from a positioning perspective, as I mentioned, we do expect a recession. We do expect quite a bit of volatility for the year ahead. Inflation very likely to stay around, so it seems to be quite sticky. That means that interest rates likely to be much higher for longer. So on the back of all of these reasons, we are overweight still our themes, which I'll touch on over the next slide. Non-US stocks are likely to do better than US stocks over the next year. So we underweight the US in favor of other regions such as emerging markets, China, and the Eurozone. We are overweight South African bonds, as I mentioned, and underweight South African equities. So the US is still the largest proportion of global portfolio of the global portion of the portfolios. However, relative to a global benchmark, we are slightly underweight the US in favor of emerging markets. And specifically in the US, so we do invest a big portion of the portfolios in the US. But in the US specifically, we rather overweight select themes such as US value and healthcare. Now, US value is an investment theme that tends to do very well in a rising interest rate environment, and healthcare, I have a slide where I will touch on the reasons why we're still very positive on healthcare and the reason why it's included as a theme in the portfolio. So I have mentioned a number of times that we do expect a low return environment going forward. And for this reason, at Sygnia, we do believe in thematic investing. And thematic investing for us is the answer to investing in a low return environment. So thematic investing is all about identifying key themes that, despite the volatility that we see in the markets and despite the low growth, these are themes that can provide good growth in the portfolios through these market cycles. And the way we see it is, for every big global headwind, there is an opportunity from an investment perspective. So if you think about the headwind of decarbonization, the answer, we believe, is investing in sustainable economies. And we have included the sustainable economy ETF in the global portion of your portfolios. If you think about deglobalization, in our view, the solution to that is to invest in the emerging consumer. And that's where you see investment in emerging markets that are set to grow much faster than the developed markets. The high debt levels that we see around the globe. Now, the world is sitting on a lot of debt. And this debt has become even higher after the COVID-19 pandemic, when a lot of nations around the globe had to take on extra loans from the IMF, from the World Bank and other institutions in order to assist their people through the lockdowns. And high debt typically equals low growth, because when countries are sitting on a lot of debt, when they receive income from taxpayers, instead of using that income for growth initiatives, they need to use that income to pay down debt. So we do believe that due to these high debt levels, we are in this low growth environment, and we believe that investing in disruptive technologies is the answer to the low growth environment, because these disruptive technologies are technologies that will change the world despite the volatility that we're seeing. So it's a theme that can grow through the market cycles. And then the aging demographics. People are getting older and older, and in our view, there's an opportunity to invest in health innovation. And speaking about health specifically, if you look at the median age of the global population, which is the chart on the top right-hand side, you can see it is growing. So people, thanks to the advancements in healthcare, thanks to the early diagnosis of certain diseases and the advancements that we have in medicine, people are able to live much longer today than they were a couple of decades ago. At the same time, the birth rate is lower, and that is why the global population overall, is in the situation where the median age is actually rising. Now, from a spend perspective, of course, it makes sense that older people spend a lot more on healthcare than, younger people who, typically don't have any problems and don't need to take any chronic medication. And from a numbers perspective, the average 85-year-olds spends 10 times more on healthcare than the average 25-year-old. So this is where the opportunity lies. As you see, there's going to be more and more of these 85-year-olds going forward as this population is rising. The old people are becoming more and more around the globe. Now they're spending so much more, and this really is the opportunity to invest in healthcare. That, along with the fact that governments themselves spend a huge percentage of GDP on healthcare, and of course, all the exciting innovations happening in the healthcare space, such as the 3D printing of human tissue, the use of artificial intelligence. There's many, many exciting innovations for the healthcare space. And for this reason, we truly believe that there's a place in every portfolio for healthcare investment. Healthcare also did very well in 2022. It's seen as almost a defensive sector. Even if there's war, even if there's high inflation, cost of living crisis, unfortunately, if people need chronic medication or operations, despite what may be going on in the world, they're still spending on healthcare. And for that reason, it's, some analysts call it recession-proof. So this is really the motivation for the healthcare portion in your portfolios. And then lastly, and very importantly, what I want to cover is the strategic assets allocation update. So every year we look at the asset allocation of the portfolios, and we have a look at whether that strategic asset allocation needs to change. Now, the strategic asset allocation is the long-term asset allocation, and then on a short-term basis, we do filter portfolios, and that we call the tactical asset allocation. Now, this is arguably the most important decision for every portfolio, as many studies prove that 90% of the return variability of portfolios is explained by the strategic asset allocation. Now, we haven't changed the strategic asset allocation for a number of years. We've rather just been moving tactically. But last year, there were a number of things that changed. Firstly, there was an update to Regulation 28, which is the legislation that tells us where we can and cannot invest retirement fund monies, and the offshore allowance was increased to 45%. Then, on the back of this low return environment, we have reviewed our return assumptions for the various asset classes, which I will show you on the next slide. And then, again, due to this low growth environment, alternative investments are becoming increasingly attractive because they are rather uncorrelated to your traditional asset classes. So just looking at the real return expectations, you can see what we expected in 2022 and what we're expecting in 2023. Where SA equity is expected to give us lower returns, international cash is expected to give us lower returns, international bonds are expected to give us lower returns. So on the back of the changes to regulations, as well as the changes to our real return expectations, we have made a number of key changes to the strategic asset allocations. Firstly, we have increased our global allocation by 5%. Secondly, alternative investments are becoming increasingly attractive. As I mentioned, they're quite uncorrelated to the broad asset classes. So we've entered global alternatives at 6%. And then because of the higher allocation to global assets, we have also increased South African bonds. South African bonds are a good hedge against the strong rand. So when you have a higher offshore exposure, the rand volatility will have a bigger impact on the returns. So to balance that, we have included a higher allocation to South African bonds in the portfolio. So looking at the conservative, moderate, balanced, and aggressive models, so if you look at 40, 50, 60, and 70, this is a summary of the changes. So global equities increased by 3, global bonds decreased by 2, and you can see a summary of the changes across all of the asset classes. So I'll pause here for a moment, just showing you, if you look at the second last line, I just want to mention that the total equity exposure has not changed. So the portfolios, the 70 portfolios are still roughly 70% invested in equity. So that hasn't changed, but it's really changing, reducing the local equities in favor of global and making some other adjustments. So the total global exposure has increased by 5% on the back of the increase in regulations. And then this is a summary of the exact percentages in each asset class as at the end of January. So this is where you can see the higher offshore exposure. So, and what we're showing you is the strategic asset allocation. So this is where you saw the changes that took place in December. And then on a tactical basis, over the short term, you can still expect to see some movements, and we make these movements on a short-term basis to take advantage of the current market environment. And that then brings me to the end of my presentation. I will gladly take some questions.
Eva, thank you very much for a very enlightening presentation. We don't have any questions, unfortunately, from the audience, but I've got a few that have come up in recent discussions with colleagues in the office. For example, we heard towards the end of last year and again at the beginning of this year that there's significant retrenchments in the tech sector in the US. Do we need to be worried about that? So we know some of our themes like the fourth industrial revolution were quite severely affected last year through increasing interest rates. With this, is this something for concern?
So with the themes that we follow and with thematic investing in general, it really is about looking through the short-term market cycles, through the volatility, and looking at the long-term opportunity set. And due to the fact that we're still expecting interest rates to remain higher for longer, it is likely that tech broadly still struggles through 2023. But it is a good opportunity to, get in at the low prices. In fact, in January, the Fourth Industrial Revolution Fund, just for that month alone, gave us 15% positive. So we can expect it to be volatile as the Fed, goes through their decisions with regards to interest rates. But looking beyond 2023 is really where the exciting opportunity set lies. So yes, tech likely to struggle in a rising interest rate environment, but we're looking beyond that. We're investing retirement fund monies. So it really is about the long-term opportunity for inflation-beating returns over the long term. And of course, bearing in mind that from a positioning perspective, it's by no means an overly concentrated, position in the portfolios. It's very well diversified with healthcare, with US value, with other regional exposure.
Great, thank you. That's quite reassuring. Just another one linking to sort of our offshore investments, with the change in Regulation 28 and exchange controls more precisely, we can take 45% of the portfolios offshore. In the most aggressive portfolios, we're around 33%. What's driving the decision not to go to 45? Is there some really strong thoughts around that asset allocation decision?
So we again model the portfolios bearing in mind that the beneficiaries of the investment returns are the fund members, and member liabilities are based in South African rands. So these members are likely to, retire in South Africa and use their money to spend in South Africa. So when your liabilities are based in South African rands, it's very important then to, model the portfolio accordingly. And for that reason, a bulk of the assets are still invested in South Africa across bonds and cash. Then looking from a valuation perspective, South African equities, as much as, from a growth perspective, we don't expect much from South Africa, there are really good pockets of opportunities in the South African market. And from a valuation perspective, they remain attractive. And I've already mentioned how favorably we view the bond market. And for that reason, we overweight South African bonds. So it really is a balancing act and looking at the real return assumptions, what you're expecting over the next couple of years from the various asset classes, and in modeling it accordingly to give you that inflation-beating return. We can expect to see it increase over time, but for now, it really is the valuations of the South African equity market versus offshore markets, together with the fact that, the liabilities of members are based in SA rands.
Based on the long-term track record, you guys are certainly great at balancing. So well done, Eva. Perhaps a light-hearted question. Who are you throwing your hat in the ring for when it comes to the Minister of Electricity in South Africa?
I have absolutely no idea, to be honest. I mean, I cannot wait to see, who gets that very, very difficult job. But yeah, let's hope that he's a miracle worker.
Bushi. Thanks, Eva. We appreciate it. Great session. And let's hand over to Leanne van Wyk, who's going to talk to us about the very daunting Conduct Standard 1 of 2022, in collaboration with Colleen, who's going to give us a little bit more insight from what SURF is doing to comply with those regulations. Leanne, Colleen, over to you.
Thanks so much, Dwayne. And just let me know when the slides come up.
In progress now, it's up and running.
Okay, thank you so much. Right, so good morning, everyone, and thank you again for joining us. And just a few things about what I'm talking about today. So the law in relation to contributions and to the contribution statements, the contribution reporting that we do, as well as if we engage with attorneys, has changed. So this morning, just while I was getting ready for the webinar and I was about to blow dry my hair, I got a message on my phone to say the FSCA had changed the prescribed reporting. And that's what I'm talking about today. So anyway, I had to air dry my hair and I'm having a bad hair day as a result. But the good news is all the new stuff is in the slides. So the FSCA issued a guidance note and a new notice today, and we will talk about that as part of the presentation today. Please think about your questions, and you're welcome to either add them to the Q&A or chat so that Dwayne has them by the end of my session, or you're welcome, or else Dwayne will simply ask me questions at the end. But it'd be lovely to hear from you. Okay, so you're probably wondering why I've got squirrels and nuts on my slides. So I very much see contributions as the acorns we need to plant in order for our healthy retirement fund oak tree to grow. So without the acorns, the contributions, you don't get the retirement fund tree. Well, I love squirrels and that's my story and I'm sticking to it. But let's have a look at why a new conduct standard. So last year we saw Conduct Standard 1, 2022, and that's, as I said, deals with new contribution statement requirements, reporting, etc. So why is it there? So the FSCA said that they wanted to address some of the shortcomings in Regulation 33, and we see that, and we'll see it as we go through the slides. And they also wanted to standardize some of the reporting that we have to under the conduct standard. So Regulation 33 in the Pension Funds Act, which has been there all along, falls away and it's replaced by this conduct standard. So remember, a conduct standard is law. So it actually goes through Parliament, it's subordinate legislation. So it's not nice to have, it is something that we actually have to comply with. So the whole industry has been getting ready for this behind the scenes as Sygnia and SURF, and that includes communications by funds to participating employers, by administrators to participating employers, by funds to employers, the whole works. There's been lots of communication going on. I know, Dwayne, you sent out a law in September last year dealing with this, and that you are planning an emailer to participating employers to update the information and add the new requirements as well. So that's all good, all as part of this value chain, right from the employer through the administrator to the fund, the board, and then everyone else we have to report to. We all need to know what's going on. Other actions that are going on in the background include either system updates or updates to the fields required in the system so we can log all those persons who are required to have reports either provided to them, for example, the monitoring person of the fund, or that we're required to load onto our system, for example, the persons responsible employers for contributions. So lots of those changes going on, as well as changes to processes. These are administrative fund and employer processes where we need to get our ducks in a row in respect of the reports that we're going to have to provide where necessary, as well as the format of those reports and the timing of those reports. Website and portal update to make sure all the right fields are in there. So that's also been taking place. Contribution statement updates. So this is from the employer side as well, you know, how that is done and the fields that you need to include. Fund policies. So for example, some funds in their communication policy talk about the type of communication out to members and others, and they might look at you know, making mention of this type of reporting in those policies. So lots of action taking place behind the scenes. So what is the timing of all of this? So as I said, the conduct standard was issued last year with a 6-month lead-in period, and actually the conduct standard becomes effective today. So great timing on the part of Sygnia and SURF for the webinar. Today is the date that all of this that I'm talking about today becomes effective. So in summary, I've just given you a summary of what is in the conduct standard. So it includes everything from prescribed notices that the fund has to provide to the employer on an ongoing basis, the contents of contribution statements, the liability of the employer attached to the contribution statements. And we're going to talk a little bit more about that. Reporting when things go wrong. So where there's a failure or contravention of the act, what reporting has to take place, what timelines, what do you have to report, who do you report to, and actual prescribed reports. So there are 3 prescribed formats, and we'll go through some of those today. Then penalty interest, what it is, when it applies from, when it's payable, etc. And then lastly, a whole new section of the conduct standard, because it wasn't in the old regulation 33, are the requirements around what the fund has to comply with if it appoints an attorney to gather, for example, arrear contributions. Okay, so we'll talk a little bit about that as well. Okay, so we know that this particular notice was sent out in September last year, and it contained the prescribed reports. So there's 3 prescribed reports that we're going to go through today. However, today, the FSCA reissued those prescribed reports, those 3 prescribed reports, and we will go through the content of those at a high level. It, at the same time, issued this communication around why it reissued those reports, and we'll go through that in the slides as well. Okay, so there are 3 prescribed reports. The first one is the format of the notice that goes to every employer from the fund, and we'll have a look at that. The second one is the report to the FSCA, and the third is the report to SAPS. So let's start with this particular topic. So from now on, from today on, every fund before a participating employer joins, so before it actually participates in a fund, will have to provide every participating employer as it comes on with notice of its obligations for contributions. So it's quite a scary notice in that it talks about personal liability of directors at the employer, etc., etc. So sometimes it's necessary to just contextualize that for the employer to say, understand, we're giving you this because we're telling you about your obligations up front. We tell all employers the same thing, and it's a prescribed format. So that has led to some funds wanting to attach a sort of covering letter to the prescribed notice, and that is perfectly fine. You can do that. Then on an ongoing basis, the FSCA now will require through this conduct standard that there's this ongoing notice. Now, what we get out of this, and I'm going to show you the notice in a minute, what we get out of this is that the FSCA is focusing much more on employers and their obligations with respect to contributions. Okay, so it's increasing its focus on employers. And it's introduced this concept of direct enforcement against an employer for 13A, so contribution contraventions. And the FSCA specifically stated that it will use its enforcement powers against employers and issue penalties. Now, if you look at, this is a little extract from the comments that the FSC made when they issued the conduct standard. So what happens is the conduct standard goes through a little consultation process, and part of that is everyone comments. The FSCA then puts its replies in relation to each comment, and that goes out with the conduct standard. Now, you will see here the concern being raised about enforcement against employers, and the FSCA stating in their reply that they believe that they have the power to enforce penalties against the employer in terms of the Pension Funds Act already. And here what they're talking about is Section 37 of the Pension Funds Act, which talks about the fact that the FSCA can issue a penalty against any person, which would include the employer or a director at the employer, for example, with respect to contribution contraventions. And those penalties are up to 10 million rand, 10 years in prison, or both. And of course, it would have to be something very serious for imprisonment, but still, you know, it is there. So they're saying we can do this, and we are going to do it. And they specifically talk about contribution statements in the comments, and they say, if you look at this little square on the right here, it says that the requirement to submit the necessary information, and they're talking about contribution schedules here, to a fund is placed directly on the employer. Therefore, if an employer does not provide the information to the fund, the employer is in contravention of the law and is liable to incur a penalty. Okay. Very clearly, we see the employer being brought into the enforcement fold here. So just to remember, this is a quick aside, but it's something quite useful. Under the Conduct of Financial Institutions legislation, so the Coffee Bill, which is due to become law this year, the employer or participating employers in a fund, whether it's a standalone fund, an umbrella fund, whatever it is, become supervised entities with respect to contributions. So you can see in COFI, it actually includes the definition of supervised entity. You'll see where I've added the arrow there that it includes participating employers. And the import of this, it is that supervised entity can be supervised and regulated by the FSCA. And that includes FSCA using all the enforcement powers that they have against the supervised entity, which now, once COFI becomes law, will include a participating employer. So very clearly, we see this desire by the FSCA to bring the participating employers into the enforcement fold where they can take direct action against them. So where you see something in the conduct standard that talks about this is an employer's obligation, we need to bear this in mind. Okay, so I was talking about notifications by the fund to all employers. There needs to be one upfront. And then on an ongoing basis, every year, the fund will send the same notice to the employer again to remind it of its 13A obligations. Again, as I said, it's quite a scary notice because it talks about personal liability and all sorts of things. But just to note, if you receive one as an employer from the fund, it's because all the participating employers are receiving the same notice. Okay, now just to mention that that notice can come at any time of year. For example, the fund could decide that it's choosing one date to do it, you know, for example, benefit statements or whatever they want to do it. And it doesn't have to be on the anniversary date. You won't find that in the conduct standard. You'll see this little block at the top right here. That's an extract from the comments that were issued with the FSCA, where it says it doesn't mean that you have to issue this notice on the employer's anniversary date. It can be done at any time during the year. Okay. Just to note as well that part of the notice to the employer is a request. And what this request is, it's the fund asking the employer, who is the person at the employer who is personally liable for contributions in terms of the Pension Funds Act. So Pension Funds Act already says that the employer has to tell the fund who the persons are who are personally liable for contributions. Okay, so now this notice actually includes that request. Remember that if the employer does not get back to the fund and say these are the persons that are personally liable, then it is all the directors of a company that become personally liable. Okay, so it's better for employers to get back to the fund on this than not get back to them, right? Just perhaps to mention a little bit of what the format looks like. So this is the request. It goes off to the managing director or equivalent, I assume, because not all companies have managing directors. You will notice on the next slide that the fund has to, this is a prescribed format, the fund has to ask the employer to provide this information within 14 days. Okay, so if the fund has to get the information from the employer within 14 days, this is now something that the fund has to monitor. So usually that would be monitored by the administrator, depending which fund it is, but that means now that the administrating monitor has this come in, but it come within the 14 days and then provide that information through to the administrator, usually through, for example, something like the admin report. Okay, so this, just to note who these persons are in terms of an employer, so if you're wondering who they are, what the Act says is if it is a company, and that's most participating employers are companies, if it's a company, then it is every director who is regularly involved in the management of the company's financial affairs. Okay, so those are the persons you need to notify. And you will see here that you must notify their identity and their particulars. Yeah, but vague, identity, name, ID number, perhaps particulars, I'm assuming contact details or their position, you know, that type of thing. But every fund will decide, you know, what particulars it will need in order to comply with this particular requirement. Okay, this also makes it a little bit easier on employers, of course, because that means that, you know, they've got, for POPIA, the Protection of Personal Information Act, employers are very careful about what information they provide. And now, for many conditions in POPIA, we know that one of the things we can rely on is that it's a requirement of law. So employers now have to provide this information, all the information specified, including the director's details and particulars, as a requirement of law. Okay, so let's talk a little bit about contribution statements, initial and subsequent. So again, there are prescribed formats set out in the conduct standard, but this is not one of them. So there is no prescribed format for contribution statements. What is prescribed, though, is the content of what must be provided in contribution statements. Okay, so we know contribution statements have to be provided either with the contributions or within 15 days after the end of that month, and that is in terms of the Pension Funds Act. Now, when we go through this, don't forget, this is the minimum prescribed information that must go into contribution statements, and a fund can decide to ask for more. Right, so I know that all along has been asking for, I would say, most of this information. So there isn't a lot of tweaking to be done in relation to the portal or contribution statements and information coming in, but we'll talk a little bit about that in a minute. So this is a very busy slide, but the reason is that I wanted everything on one slide. So everything in the orange block on the left is what has to be in your first contribution statement. And the only new things there are those that are underlined. Income tax number, which is great because it means if there's section 14, we're not casting around for income tax numbers, also helps for payment of benefits, etc. And then just note the contact number, this is of members, including where available, the cell phone number and email addresses were available. Now, my note to employers here would be, it doesn't say where you want to give it to the fund. It says where available. So, you know, I've spoken to both funds and employers about this, and I've said, if it is available to the employer, then they must make it available to the fund. Okay, it's not a choice as to whether to provide it. If it is available, then provide it. So that is contact numbers, email addresses where available. Compared to the previous draft of what was going in here, this is quite sensible. So I don't think that most administrators, and certainly Sygnia, would have a problem with these requirements. Then in all contribution statements following your first one, you would then add your membership number, because the members would now have one. And then very importantly, the conduct standard makes it the employer's obligation to ensure that it shows any differences in data or changes as compared to the previous contribution statement. Okay, and you will see this addition of or any other information that may be relevant. So here, this is casting the net wide to say to the employer, if there's something relevant in relation to contributions for a member or all members or category of members, doesn't matter what it is, you must provide that information to the fund. Okay, so very clearly putting the onus or the obligation on the employer to provide any changes or new information to the fund. And we'll talk a little bit in a couple of slides to come about how Sygnia will help with that. Okay, then just on all contribution statements, another new requirement is that the employer has to include a declaration. So if this is on the portal, it could include a little tick, for example. If this is some sort of manual upload to Sygnia, then it would have to be done perhaps as part of your document. But on every contribution statement, the employer has to declare that all employees eligible to be members of the fund are on that schedule. Okay, so basically here the FSCA is trying to ensure that no members, you know, for example, new employees as an example, or promoted employees, whatever it is, are left off that contribution statement and appear there when they should. So clearly this is again the employer's obligation. Okay, I'm going to move off this a little bit, although you will find this impacts on reporting to be done. So if we look at the reporting process, this is just a high level look at it, because I think if we understand the high level look of it, it becomes a little bit easier. So when you receive the slides, there'll be a lot more detail in the slides that I'm going to go through today, in order that you can refresh your memory. And also, some of this was in the law review and will be in the employer email. So if we look at the reporting that has to be done, obviously it starts with the person that receives contributions or should. So that is the administrator in the case of SURF. So your administrator receiving the contributions, they know if contributions have been received, etc. They report through to the monitoring person or the PO at the fund. The monitoring person is just the person that the fund has appointed to say, you watch contributions and report on it. Okay, so if we appointed a person like that, then it would be the monitoring person. So the administrator reports to the PO, principal officer or monitoring person at the fund. The fund then, the monitoring person or the PO then tells the whole board of the fund. So that's the second leg. Once the whole board knows, they then have reporting requirements through the FSCA, where there's a prescribed format, and to affected members, where there isn't a prescribed format. Then if this whole problem carries on for 90 days, there are then further reporting requirements, where the board then has to report to members again, as well as to the South African Police Service. Okay, so that at a high level is the reporting. If we look at that first report, and you'll see from the diagram that we've just done, you'll see a little extract of it on the right there. So this report is going from your administrator through to the principal officer or monitoring person of the fund, right? And it has to be done within 7 days after the end of the month, in which the contributions are due. Now here, reporting on whether contributions have been paid, whether contribution statements have been received, do the two tie up, or is there discrepancy? Note that the administrator does not have to report if the discrepancy is less than 2.5% of the total contribution payable, but they can still choose to. So they may decide, no, we will report, no matter what the discrepancy is, or they can decide, no, we'll just report if it's below 2, if it's about 2.5 or above. Okay. So that little bit in the square at the top is the FSCA just confirming that. Right, so now the principal officer or monitoring person knows there's a problem with contributions. Then you expect that the administrator would go to the employer and say there's a problem, right? But there's no such requirement in terms of the conduct standard. They just forgot to put that bit in, right? And this has become a problem in the past where the administrator or the fund hasn't gone back to the employer and said, you know, you've got a problem with contribution. Employers thought all along that they were fine. So there actually was a case which I've mentioned on the slide. But of course, this is something that Sygnia does. It is part of its process, and the employer will be notified that there is an issue. Now, when they do that, let's talk about the portal EPIC versus non-portal contribution codes. So if possible, in my view, it would be better to upload it using portal because that means you immediately get data integrity reports in relation to the actual information that you provided to the fund. Have you provided 100% of the information required, or is there something left out? So immediately the employer would be aware, oh, wait, we've got a problem here. We haven't uploaded all the information required. There's a report that compares what was received this month to what was received last month in relation to contributions. So that is very important because what that does, it is Sygnia or the fund assisting the employer with its obligation, right? So it's the employer's obligation to get this information right and to provide it. But here, Sygnia is saying we haven't received all the information, or what are these changes that don't make sense in relation to previous contribution statements. So all of that is assisting the employer with its obligation. Okay, so those sorts of reports are important, and it's important that there's this backwards and forwards between employers and the administrator, because the employer at the end of the day needs to somehow sign off or click that approve button in relation to saying, all right, we're done, all those queries are finalized, and we're happy with what we've submitted. Okay, so then the monitoring person is aware of the information and now must report this through to the full board. So they're just basically taking the information that was provided to them to say there's a problem with the contribution statements or with the contributions themselves and providing that to the full board. Right, and they've got 7 days from the PO and the monitoring person have got 7 days from when they received that report to provide it to the board. Then the next 2 reports. So now the board has got the report. What do they need to do with it? They need to do 2 things. They need to provide a report to members and to the FSCA. So the member report is not a prescribed format, so the board can choose what information it puts in there. But one of the things that they should add to that is what they are doing to rectify the problem. Okay, so the board has got 30 days to do that. So hopefully they use that 30 days to rectify the problem, and then at least they can tell members, well, this was actually done and dusted and, it's over, but failing that, what they're doing about it. Now, if you've got a contribution issue in relation to one member, then you just tell that member. So you just tell the affected members. if you can't tell which members are affected, for example, your contribution payment is so out of whack with your contribution schedule, you can't tell what contribution should go where, then you tell all the members. Okay, the report to the FSCA, same timing, 30 days, is in a prescribed format. And it is this format that the FSCA changed today. And though it give me gray hairs in relation to this presentation, it is actually a very welcome change. It is something that I actually raised with an industry body saying I think it needs to change. And so I'm glad they've changed it, I'll tell you a little bit about what has changed. So when you submit this information, this prescribed report to the FSCA, it's now clear that you can either submit it through this report, this prescribed format, or you can submit it through the FSCA's online portal. So you can do either. All right, you can submit it through this type of prescribed format, or you can use the online portal, and that's good. The other thing is that it used to be a report per employer, and now the fund can do a consolidated report for all the participating employers, okay, which will save a huge amount of time running to keep submitting the same thing for different employers. You have a list. Okay, so the FSCA, this is a little extract from the communication they issued today, just stating why they have changed the prescribed format, and it's actually the FSCA's prescribed format that changed, not the others. So if you look at the FSCA's notice, it is straightforward, comes from PO, the monitoring person, and then you've got to choose what the contravention is. So is it that the employer didn't provide the information or didn't provide all of it? Or, so you didn't get anything? Or is it that the employer did provide it, but it's wrong or incomplete? You've got to choose one of those, or you didn't get contributions, or you didn't receive them in full. So you're going to choose one of those three things, which is what you're providing the notice with respect to. And once you've chosen one of those three things, you then have to say, this is the action that we're taking. You've got to set out that action. Just to note as well that you've got to provide a monthly update on this. So it's not a once-off report to the FSCA. You've got to provide a monthly update to it. And I'm assuming that monthly update will only cease once the problem has been fixed. Okay. The last two reports are when 90 days has gone by and you still have this problem. In that circumstance, the fund's going to report our affected members and to SAPS, the South African Police Service. The South African Police Service report is in a prescribed format. It's very long. We've got lots of evidence to attach about contributions and rules and participating employer, participation documents, lots of info. Okay, and what the FSCA have said is that they have engaged with SAPS to talk to them about this in order to raise awareness around it, and so that it perhaps could be a smoother process when a fund actually goes to SAPS and says, this is what I'm reporting, and SAPS are like, I don't know anything about that. Because at least now there is a prescribed format and SAPS has been trained to some extent. Interest on late payment contributions. So it's prime plus 2 compound interest. So the penalty interest rates, and you're going to start paying that penalty interest. So say your contribution is due in January, paying by the 7th of Feb, your penalty interest will start accruing from the 1st of Feb. Okay, and then you've got about 2 months to actually pay that penalty interest. Just the last thing I'm going to mention, and then I'm finished, Dwayne, is that there's quite a large section in the conduct standard, and it's brand new, around if the fund outsources the recovery of contributions to an attorney, there are certain things you have to comply with. So the conduct standard sets out what you must have in your agreement, it states that you must avoid conflicts of interest. For example, the FSCA don't want you appointing the attorney's firm if that attorney's firm has a trustee on the board, as an example. That would be an example of a conflict of interest. And what those agreements should include, including that fees must be reasonable and commensurate. The trustees have to direct the actions of the attorney, so they must be involved in deciding how these contributions are going to be recovered. If the attorney recovers them, they've got 7 business days to pay that amount from their trust fund into the funds account. And then the fund must agree things like how you're going to report back to us on this, what timelines the trustees, the attorneys have got to do the things they have to do, etc. So you can see the FSCA saying in this little block, we can't prescribe to trustees what they must do, but where there's an outsourcing to an attorney, these things do apply. Okay, so a world tour of our new law in relation to contributions and contribution schedules, etc. And I'm happy to take questions if there are any, Glenn. Glenn, I think you're on silent.
Fell for that one again. Thanks, Leanne. Unfortunately, we don't have many questions or any questions at all. But I think there's a couple of important points to make. Leanne, the one thing that I think the industry has always struggled with is the difference in timing between when contributions are due, the 7th of the following month, versus the date at which the actual underlying date of the member statement, the contribution statement, or contribution schedule is due. Firstly, why is there a massive difference between the two timelines? And secondly, why has the regulator persisted with that difference?
Yeah, so there is. So you would know contributions are payable within 7 days of the end of the month, whereas contribution schedules are only due within 15 days after the end of the month. So you either provide your contribution schedule with your contributions, which is first prize, or within 15 days. Now, that is really antiquated. It's not something that many people apply anymore. And it really goes back to those days where you'd have to deliver a file to your insurer or your administrator or a disc or something like that. So it was to give them the time to do that. And many of those processes at the employer in relation to producing that contribution schedule were manual. And there wasn't a seamless run through between the employer's payroll right through to the administration system. So it's really a hangover from the past.
You would think it would have been an opportune time for that to be rectified. We've got a really important question that's come through, and the question is, many consultants or intermediaries are performing an administration function on behalf of the employer. So they potentially have the services extended to them doing the reconciliations and the monthly submission of the contribution schedules via Epic to SIF. In that instance, where there's a late payment or incorrect calculation, breaching the tolerance level of 2.5%, or the data is submitted late, who remains liable? Is it the intermediary or is it still the employer? It's quite a tricky situation, but perhaps you can give us some guidance.
Yeah. So the answer is it's always the employer. So even if the employer has some sort of outsourced arrangement, or sometimes even I've seen funds have that outsourced arrangement, if you've appointed someone else to do something for you, you still remain responsible in terms of your statutory duties. It may mean, for example, if there's a penalty levied against you, or there's penalty interest that's payable now, that you can claim that from source provider, but the point is you remain responsible under the law, both to the fund and to your employees.
So I suppose it comes down to the contractual arrangements between the intermediary and the employer in terms of who actually pays the late payment interest in that regard. We have another interesting query, and that relates to essentially nil contributing members. So this conduct standard is focused on the late payment or the non-payment of contributions and the implications thereof. What about those individuals where we're simply not receiving contributions? Does the conduct standard make any reference to those individuals and the action that's taken or that's needed to be taken by the employer?
No, it doesn't. So they would just be a member, and all that same information that you have to provide for your contributing members has to be provided with respect to members who are not contributing for whatever reason.
Fantastic. Perhaps, Colleen, could we get you online just to talk about, with Leanne, talking about what are some of the initiatives that SURF has taken or Sygnia benefit administrators to comply with the conduct standard?
Yeah, so I think firstly, we actually always wanted to have most of this information. It's just in the past we had to ask nicely, where now we can actually refer to a conduct standard. So employers that would know that they've been receiving data validation reports for quite some time now. So on the data validation reports, we will indicate where we have not received certain bits of information. And we're quite lucky that quite a number of our employers are actually sitting at 100% compliance rate. So the employers are actually taking this quite seriously, which we do appreciate, because a lot of this information helps us, you know, in this instance where someone does become a null contributor, that we can actually track down that member and try to help them to get their, you know, their benefit, or to get a form from them. Just on an ongoing basis, we are busy updating EPIC, which is the online portal. So if employers do use EPIC, that will be updated to actually cover quite a lot of the requirements. So for example, them confirming who a responsible person is, we're adding that disclaimer at the bottom that when they click approve, that they're actually confirming that the information is up to date. So we're actually going to try and help employers as much as possible, that as long as they use EPIC, that they are actually in compliance with most of these requirements. As in the past, we prefer employers to do exports from their payroll system and import it directly into EPIC, so they don't need to, you know, manipulate any schedules outside of their system that could result in errors or, you know, information being misaligned, etc.
Thanks, Colleen. Very detailed. Probably a more controversial element of the conduct standard is the communication, or the more frequent communication to members. Now, this has always been a requirement of the existing regulations, but it's somewhat at the forefront of this conduct standard. Can you confirm, you know, what's been done previously in terms of communication with members via the principal officer, and what is your intention in terms of complying with this conduct standard?
So I think in the past, the communication with members were only forced quite late in the process. Now, as Leanne mentioned, it is now on a monthly basis where there is non-compliance. I think my only concern with it is quite long after the non-compliance. So if an employer pays on the 8th instead of the 7th, it's non-compliance and we have to report it to the members. So I'm just a bit concerned about confusion with members following up 2 months later with the employer on why they paid late, and not as and when it happens. So what we are planning to do is we will use the SMS functionality, just because most members do have cell phone numbers. Not all of our members have email addresses, and we will be sending communication via SMS to the members where there are instances of non-compliance. It's just the email correspondence then requires us to send the correspondence to the employer and rely on them to distribute it to members.
Scary times. We're expecting a lot of feedback on that. But Leanne, Colleen, if I could ask you for one question and perhaps a word of advice to our intermediaries who are needing to take this conversation to their clients, what is the one key thing that you'd like to leave them with, or a tip that you'd like to leave them with?
So for me, Colleen, while you're thinking about it, for me, because I always come from the legal point of view, is they need to make it clear to the employer clients whose obligation this is. You know, we see time and time again, oh, I don't want to use a portal, it's too hard, or whatever the case may be. Anything that can help the employer with its own compliance with obligations is, you know, should be used. So to the extent that you can encourage your participating employer to use what's there for their compliance, you know, better. So use the portal if you can, rather than you know, trying to reinvent the wheel yourself, and then all this manual work has to be done around whether there's compliance.
Brilliant. Thank you, Leanne.
Yeah, I will reiterate Leanne's comment, is please use the portal. It's not necessarily to just make our lives easier. It is there for a variety of reasons. It prevents the, weeks-long back and forth via email or phone call to resolve differences. It helps us as well, there's upfront checks, but in addition, our admin team does still check the outputs that come from the system. And if anything does still look odd, they will actually contact the employer to query it further. So we don't just accept the data and push it through. There is another sense check that happens. I think also from our perspective, the information required all makes sense, and that's why we've been requesting it for some time. It's not to market to members, it's not to contact them for no reason. It is to help the employer, if there's a breakdown in relationship, it helps us when there's transfers to actually already have the tax numbers. It means we don't then need to start and collect information from the employer to then actually do further processing that's required.
Thank you very much for a very informative session, and we look forward to seeing how we practically implement this and take it from there. So thank you very much, Leanne and Colleen. Last but not least, we have Olufile, who's going to talk to us about beneficiary funds and the value that FAIR adds in the process. So Olufile, take it away. Thank you very much.
Thank you, Dwayne. Can you see my presentation there?
Yes, we can.
Okay. Thank you to Leanne and Eva. I'm going to make an assumption here that we all know what we need to read after this presentation. That was surprising news from the FSCA. Beneficiary funds. We've had this product for years and years. Let us assume that one of the major questions that we always ask ourselves in this industry is what happens when a member dies. Let's assume that Eva has been giving us the numbers that we're looking for, the 15%. We've contributed and adhered to the conduct standards in terms of contributions, but the member dies. That question has been there even in the 80s. One of the challenges in the 80s was that we still have testamentary trust, the options in terms of annuities, but those options also come with one big challenge, costs and also management. In a testamentary trust, for example, the issue of trustees, the reputation of the trustees, paying of trustees. So in the 80s, that was conceptualized the concept of umbrella trusts. So in 1989, the umbrella trust, the first umbrella trust was set up and FAIR initiated that. That expanded through the 1990s. And then in early 2000, Fidentia happened. The Fidentia story changed the landscape of retirement funds. More specifically, it highlighted the need to have stricter regulations, specifically in terms of umbrella trust arrangements. And that brought into being in 2009, beneficiary funds. Now, beneficiary fund market is around 17 billion. That is as at 2021. Now, what is the difference between these two products? What is it? What is a beneficiary fund? What is an umbrella trust? Now, umbrella trust is a legal arrangement where a person known as a trustee holds, administers property separately from his own, obviously subject to the provisions of the trust deed. Whereas a beneficiary fund is a pension fund organization set up to receive and administer investments in lieu of employment-related death benefits of the deceased member. And it is specifically set up to take care of the minor children. And how does this work? The beneficiary fund, like I mentioned, there was stricter regulation. Consequently, it is registered with the FSCA. The benefit is invested. These investment payments are made to the legal guardian or caregiver. And when the beneficiary turns 18, the money is paid to the beneficiary. Obviously, there's a concern there. I would rather say there are options where the money can pay, the beneficiary can receive the money or reinvest it or take it partially. Now, the trust on the other side, because it is ran with the purpose of the trust deed, obviously it is ran differently. And in addition to that, there's the big tax issue. There's a beneficiary settlement investment in the trust, and it is administered accordingly in terms of the trust deed. Each settlement for a particular beneficiary is held in an umbrella trust, and it administered separately for that beneficiary. Settlement comes to an end when the settlement deed provides it to come to an end. Because umbrella trusts were set up in the 80s, most that we administer in our case, the vest condition is age 21, because that was prior to the change to age 18. Now, what and who regulates the umbrella trust and the beneficiary fund? The beneficiary fund is regulated by the Pension Fund Act and the FSCA, whereas the umbrella trust is regulated by the Trust Property Act and is registered with the Master of the High Court. Regulatory requirements are quite strenuous and also there for a reason. Remember the Fidentia story. So the trust, which is what led to the Fidentia story, are not necessarily required to submit any reports to the Master of the High Court. The umbrella deed provides for the trust to be audited annually, whereas the beneficiary fund is required to submit a lot. And top of the list is the annual audit and the submitting of reports. In terms of costs, obviously at FAIRS we run them the same. So some of the costs that have to be taken into consideration is capital and production fees, your reporting governance fees, your administration fees, fund expenses, investment expenses. And if you do a simple EAC for a 3-year-old who's got about 100,000, it will be about 2.61% per annum. If you've got 500,000 lower, 2.48 per annum. Something that we must always keep in mind, the umbrella trust is taxed. The beneficiary fund, on the other hand, the benefits is taxed before it is paid into the fund. Once it is in the fund is tax exempted. Payments out of the fund to a beneficiary are also tax-free. Critical, the beneficiary fund is not a preservation fund. Top of the list is the payment of school fees, medical costs, and any other requirements that are there to take care of the beneficiary. And yes, when a beneficiary turns 18, they are entitled to the balance. Same also applies to the trust, also noting that it is taxed in the hands of the beneficiary, of the beneficiary. Income tax gains first in the beneficiaries may be also taxable in their hands. Let's talk advantages and disadvantages. Trust can receive money from any source, employment related, all of that. Whereas a beneficiary fund can only receive funds from employment related benefits. The beneficiary fund is strictly regulated. The benefit paid by the fund is not taxed, and it is very cost effective. Obviously, the umbrella trust on the other side, there's the income, the tax, there's the income and gains that vest in the beneficiary, obviously need to be taxed. The regulatory requirements, and I am not bashing the Master of the High Court, this is reality. The trusts are not subject to the same regulatory framework as beneficiary funds and carry no reporting obligation to the FSCA. However, FAIRS administers the same way as we administer the beneficiary funds. We adhere to the regulations. Now, this is a volumes games. Whoever wants to get into beneficiary funds must understand that the words that were said by our previous president, that we need to put a face into the economy, it's a reality. This is a volume games. We are dealing with people's lives. Consequently, our approach is that of individual servicing. We've had about 842,000 calls in 2020. If you look at the split, 450,000 inbound, 392,000 outbound, 880,000 capital assist, which amounts to about 4.5 billion. 5.4 million monthly income payments. That's about 3.9 billion since 2012. 182,000 servicing requests since 2020. 930,000 SMSs since 2012. 175,000 clients terminated since 2012. So when we say this is a volumes games, this is exactly what we mean. What does a beneficiary fund and a trust do? Unfortunately, with this type of product, somebody must die. There's a death benefit allocation, employment-related benefits, there are minors, majors. There's obviously guardian assessment, because you can't make the decision without making the guardian assessment. Otherwise, again, we will be faced with the PFA's comments. Then there's also guardian counseling. Then application, deceased member, obviously, the identification of guardian member dependents. Then the sub-account is set up. There's obviously FICA requirements, birth certificates, resolutions in terms of the trustee saying paid into a beneficiary fund, and then there's investment allocation. Then there's one that is very critical, consultation. We have learned over the years that in order to have a proper, efficient communication and understanding between our members and also how we service them, it is critical that when you do set up these sub-accounts, the first thing that you do is to pick up the phone, speak to the guardian and say, the money is here, the reasons why the money is here, how this thing operates, what type of requests you can make, what type of requests are not allowed, if any. And that sets the tone in terms of the relationship going forward. What we have discovered also over the years is that when we do make these calls, some of the guardians will ask, beneficiary what? Which means that there wasn't communication when the fund was busy with the assessment part that we mentioned. So this is a critical part. There's obviously income policy, which dictates as to how much we can pay per month and how that is calculated. There's an ad hoc policy, which I can quickly mention is also based on our own model calculations of what we can afford, what can we afford in terms of the ad hoc request that the member can make or the guardian can make, and also factoring in the income, the interest and all of that. The income policy gives a number of options. You can capitalize, or we can pay monthly, quarterly, biannually, or in a number of cases, they might choose one, and then subsequent to that, the guardian gets employment and they decide to capitalize it. There's a critical process that we do annually, which is a proof of existence. This is not just your normal proof of existence where somebody calls and say, I'm here. It is an informative, critical exercise that provides us with information on, are you still taking care of the beneficiaries? In which grade are these beneficiaries? Is the guardian alive? Is the member alive? And in most cases, this is where we get to discover that, for example, where you've got a guardian on our books as taking care of beneficiary 1, 2, 3, 4. The reality in South Africa is that some of these things do happen, e.g., where the guardian passes on, but someone in the family still has the bank accounts, goes and withdraws, the bank card goes and withdraws, and it appears as the guardian is there. When you do this exercise, that's when you discover such things. And then the final process, which is to some extent, we'll call it final, but I've already mentioned that there are options, is the termination of the account. You've got the vest condition in your trust that will say, by this age, same applies to the beneficiary fund, mostly is age 18. We do not just terminate. We do a risk assessment. In most cases, you have 18-year-olds that are still in school. In most cases, you have 18-year-olds who also want to plan their future that I spoke about. And this is where the counseling and the discussion happens in terms of what do you want to do with these funds? Do you even know what is a financial planner? If you get the funds and you want to do your post-matric, do you have enough funds? What else can you do? And this is part and parcel of the risk assessment that we do when we terminate the account. We call them discretionary benefits, where the beneficiary decides that I will reinvest the money what fails. What is critical is this: if they reinvest the money, it is still not taxed, something that somehow some beneficiaries have not yet caught up to it, but it is one benefit that will add value. There's a lot that I can talk about. The exciting news that Leanne brought have forced me to limit what I can address. Death benefit allocation. Obviously, the funds became payable on behalf of the beneficiaries on the death of the member, as provided for in the Pension Fund Act. Things to consider is the fund credit. We get group risk that we need to pay, accrued benefits. We also look into primary for minors or those with disabilities. We can accept majors money, but with consent. Some other benefits to consider is guardian assessment, the capability of the guardian to manage lump sums. There's a whole list that needs to be considered, but critical to this is the guardian counseling that we must consider. And also the default position of assuming that the trustees have the powers to just decide to place the money in a beneficiary fund, or if it's not employment linked, to pay it into an umbrella trust. Does not hold. The pension fund adjudicator is very clear on this. The trustees must do their investigation. It cannot just be a default decision to pay into that. So we need to keep that in mind. The case for beneficiary fund, I have already stated in a number of ways, but critical to this, if we do decide to place the money in, this is not a preservation fund. We do not run this product to preserve the money, but it is there to take care of the needs of the beneficiary. Consequently, it is for that reason that we have all those other policies, your income funds, your ad hoc policy, your termination. Those policies are there to ensure that we do take care of the beneficiary. And it is not there that the beneficiary suffers from age 10 and then gets a huge lump sum at age 18. Then it defeats the purpose of the exercise. We also protect the benefits of minors. Money is held in the name of the member. It does not fall in the estate of the guardian or caregiver. This is a critical point. And it is primarily used for education and other living expenses. Some additional benefit, which I've mentioned already, is the tax, the institutional fees, and also professional fiduciary services. I've already mentioned the pension fund adjudicators' stand on how trustees assess guardians or caregiver to determine benefits will be used exclusively in a child's best interest. Some of the other factors to consider is the nature of care, education level of the guardian, employment status, residential status, credit record, financial positions, assets and liability, income or expenditure, health of guardian, signs of substance abuse, and mental issues, etc. Dwayne, that is my quick presentation, and I hope I have saved you some time.
Look, thank you very much for another incredible presentation. I think we sort of realize how important the work that you do. We see elements of it in retirement funds to the point where the benefits are distributed, but we don't see necessarily the last part of the distribution mechanism, which is the income payments to beneficiaries and minors. Quite interesting in terms of some of the content you've made, with some of the remarks you made, but I've got a couple of questions from the audience that I'm hoping you can assist with. So Brian asks with the benefits coming into the beneficiary fund already being taxed and the payments essentially not being taxed when being paid out, how are the accumulation of fund return and interest that's accumulated during the, let's call it the 18-year process, how is that treated from the tax perspective?
Any interest earned it belongs to the member. So there's no way that we are separating it. That also includes, someone asked me the other day that if we pay money into your account and we don't necessarily bring in the documents, what happens to the interest? So it's almost similar question. The interest still goes into the member's fund. And also, even that interest is tax exempted, by the way.
It's tax exempt, so it's no different to what we experience in a retirement fund. All that is exempt.
So it wasn't a tax exemption grant. It wasn't a tax exemption granted with conditions.
Got it. Thank you. The next question is, it relates to the POE policy that you mentioned. And essentially, is there no system in place where confirmation of whether the guardian is alive can be done quarterly linked to home affairs? So is there some form of electronic engagement integration with home affairs to check whether one of your beneficiaries or the guardian is alive? Are you currently doing that? And is there some form of integration with home affairs essentially?
So annually we do that. The first thing we do in each year is to look at the home affairs system, check death or alive status of each member and guardian, and then take it from there. The proof of existence exercise is in addition to the death and alive status such that we do on home affairs. But I also mentioned why it is a necessity, because there's other information that we gather. Is the guardian still taking care of the beneficiary? Because the guardian can be alive, but the critical question is, are they still taking care of the beneficiary? In what grade is the beneficiary? So that we check progress, because that is how you will determine if at all this fund is doing what it's supposed to do, which is to take care of the needs of the beneficiary, primary being educational needs.
Got it. Well, if you just talk to us more about the alive death status that you mentioned just now with home affairs.
There's actually not even a day's exercise. We dump it on our system, which is connected to home affairs. It brings up the status in terms of death and alive status, and then we deal with the exceptions where in the case that there's death, then another process kicks into play, which involves guardian change exercise.
Fantastic. I think that addresses Brian's queries in terms of that sort of integration that you have. Not quite integrated, but there is a process in place to deal with that. We've got another question from Ernest, and it relates to unclaimed benefits. So we know that unclaimed benefits in the retirement fund sector is a huge problem. We're talking about 50 to 60 billion that is essentially unclaimed. Do you have the same situation, given the policies you have in terms of home affairs checks, in terms of the annual POE exercise? Do you experience potential unclaimed benefits or unpaid benefits, and how do you deal with that?
Nobody's paid from unclaimed benefits. The reality is that in our case, for example, where you have a fund transferring and the data is not up to scratch or is up to scratch, but later on the guardian changes the number or changes the address, and we are dealing with mobile clients here. They move from Bloemfontein to Joburg, Cape Town to Eastland. That is the reality. And this is how those unclaimed benefits come about. But on our side, we proactively deal with it. That is why that proof of existence, for example, is critical. In addition to that, the trick is early engagement, especially with beneficiaries. What I mean by that, in our case, at the age of 15, we start engaging with beneficiaries to say that, do you know that you've got a beneficiary fund? Can we have your number? I just heard this morning that the Minister of Home Affairs stated that the new age to apply for an ID is 10 years instead of 16. Now, there's a reason for that. And I think the same challenges that we face with beneficiaries at the age of 18 only applying for an ID then. Having that ID at 10 might actually be a better way of preventing this type of unclaimed benefits where we don't know where these beneficiaries are. So to answer Brian's question, yes, we have the challenge, but we deal with it efficiently. So.
Well, I think that's a great answer. I think we've answered that question quite well. Just one more question from Brian, and that's a follow-up on dealing with beneficiaries. Is it not illegal to engage at the age of 15? Will this not play with the mind of the child? And that's a question that we have. So obviously it's quite a sensitive approach when you're dealing with minors. How do you approach it? And perhaps give us more information around that.
The legality part of it, I will leave to Leanne. But the reality is that we conduct what we call educational workshops. Now, educational workshops is we call in the guardians and the beneficiaries. And part of that exercise is not just about engaging on making sure that we collect the information. It is also educational in us. We are talking about subject choices, for example, and how that impacts your future in terms of what you want to do in matric. So the collection part is probably 2% of it. The critical part is that you've planted the seed in terms of forcing at a family level the unit to start thinking about the future of the beneficiary. That is why when I started off, I said we are talking about creating the future. And it starts with engaging at family level.
Well, thank you very much. Leanne, I'm not sure if you'd like to answer the question about engaging with minors and the legal consequences, if any.
Perhaps just to mention, and I'm sure you guys know this, but so a minor has no contractual capacity unless in a rare instance they're emancipated. But so obviously fairheads would not be contracting with the minor. So for example, Olufile mentioned that they would communicate to the guardian. And the guardian and the child will come. So, all communication needs to go to the guardian because they have the legal obligation to look after the minor's interests. But if, for example, the communication goes to the guardian and the guardian is okay with the minor interacting directly or coming to a seminar, whatever it is, and that's fine. There's no problem with that.
Awesome answer. Thank you very much, Leanne. Well, if another one to you is, and it deals with the payments to guardians. So a lot of engagement. So audience, thank you very much for your engagement here. If you are paying income streams to a guardian on behalf of a minor beneficiary and that guardian passes away, but you're still paying the income streams because you haven't been informed of the guardian, maybe the Home Affairs check hasn't really worked out for whatever reason, and you've got an unscrupulous family member who's drawing on that income that's being paid and misusing or misappropriating those funds. What are the consequences? Do you have any, or how do you go and recoup those sort of lost incomes that should have been directed to the beneficiary? What are the processes that you have in place to mitigate against those circumstances, if any?
That's an extremely difficult question to answer. I think what we normally do, the first point of call is to stop that income and then do the investigation. Our internal audit experts at this. In other cases, we've had cases where at the age of 18, the beneficiary looks back at our records and says, but there was a request for that and that and that, and this didn't happen and all of that. And they have the legal authority actually at that age to even open a police case or whatever to deal with that situation. The reality is also that, yes, that is a very good question, because especially in the type of economic environment that we have, it is difficult to control these type of things. But where they are identified, the first point of call is to notify the beneficiaries if they are of age to be notified. In most of our experience, the very same beneficiary are the ones that are informing us, and we take the legal process, the route that is possible to take. But I don't want to preempt the legal expertise in terms of what are the legal rules that can be followed.
I think you've made an important statement there, is that your engagement process allows those beneficiaries to reach out to you to inform you that it's a potential problem before you can potentially identify it yourself through your mechanism. So what it's telling us is that the communication process is working, your engagement process is working. I know we've gone about 15 minutes over time, so I think I'd like to end it there for today, and we'd like to thank the audience for your contribution and your engagement, and specifically to our panelists. So if I could ask the panelists to just pop around there and open up their cameras, and perhaps to have any final words for the day. So Eva, maybe I'll start with you. Last comments or last thoughts.
Yeah, just last thoughts. I mean, as I mentioned, volatility is expected in the investment markets to continue through this year, but it's important to hang on and focus on the long term.
Sound and sage advice. Thank you very much, Eva. Leanne, from your side?
Just a quick reminder that we're going to have extensive legal changes this year. You know, things like the Conduct of Financial Institutions Bill, the two-part system. So we're waiting to see what happens on the 22nd for budget day. So just keep an eye on the space, and Sygnia will keep you updated.
Thank you, Leanne. Tumultuous period ahead, I suppose. Colleen?
I think from our side, just that we do want to work with everyone just to get everything implemented, including any future changes. So please be in contact if there are any questions or concerns.
Thank you, Colleen, and we appreciate your guest appearance today. Olufile, any last words?
The vision statement of it says we do the right thing for the right reasons to ensure that our beneficiaries are safe with us. The safety of the future of our children is in our own hands, and it is the decision that we make that future by choosing the right product that will create a bright future for South Africa. Thank you so much.
Beautiful words, Olufile. Thank you very much to everybody, to our panelists. Have a good week ahead, and look forward to seeing you again. Take care. Goodbye.
Thank you.